welcome you all to another research seminar in finance, economics, and banking. As you well know, this is a joint organization between FMA, Financial Management Association International, and the research network composed by different universities worldwide. At the moment, 14 universities from Eastern Europe, Western Europe, Southeast Asia, and South America. So today, the university that will host this seminar is University of Bath in the United Kingdom, and my good friend and colleague, Professor Dimitrios Gounopoulos, will be the moderator of today's seminar. So I hope you enjoy, as all the other seminars today, and I will pass to Dimitrios right away. Thank you.
Thank you very much, Cesario. Of course, it is a distinct pleasure for me to introduce our today's speaker, Professor Laura Starksa, the 2022 President of the American Finance Association, the George Kozmetsky Centennial University Distinguished Chair at the McCombs School of Business at the University of Texas at Austin, who holds a PhD as well from Texas at Austin, and actually all her studies are in Texas. She teaches graduate and undergraduate courses on environmental, social, and governance investing issues. Her current research focuses on ESG issues, including the climate finance, board diversity, as well as molecular genetics and financial decisions. As a result of the research that she has produced all over those years, she has won many awards for her research, as well as for her teaching. She is a research associate of the NVI Research, member of the ECGI, senior fellow of ABFER. She has been the president as well, in addition to AFA, to the Financial Management Organization who hosts us today between 1999 and 2000, of WFA, Western Finance Association, between 2015 2016. She has been member, she served in mutual funds boards of directors, in pension funds advisory committees, also in various academic committees in her university. I should mention as well that among her publications, those include 12 Journal of Finance, 5 Review Financial Studies, 8 Journal of Financial Economics, etc., etc. And what it is quite exceptional is among her first 5 publications in her career, the 3 have been Journal of Finance and 1 Journal of Accounting Research. Laura, those are just very few of what you have produced in life, but just a summary. I would like to thank you very much for being with us today, and I give you the floor to produce your very excellent new study, Long-Term Beliefs.
Thank you very much. I am very pleased to be here and look forward to the questions and the feedback on this. Okay, so this paper and what I want to talk about today are long-term beliefs, and really they're differences from short-term beliefs. And this research is co-authored with Rick Sias from the University of Arizona and Harry Turtle from Colorado State University. And I know Rick is on, and I apologize, Rick, when I mess things up, but I think Harry's going to be on as well. So, the bottom line, I think, is that long-term investor beliefs, when we get surveys about their beliefs, they work better than short-term beliefs, and I'll explain what I mean by that. What we know about investor expectations about returns are that they're an important component of rational asset pricing models, they're an important component of behavioral asset pricing models, and they're an important component of household finance models. But beyond assumptions, what do we actually know about these beliefs? And although there exist many studies of near-term beliefs, and I won't have time to cite all those studies, there exists little research on long-term beliefs. So what do we know about near-term expected returns of individuals that have come from, as I said, a number of different studies, and these are just examples of a few of them? Well, we know there's lots of heterogeneity. We know that they're bearish relative to actual historical values. We know that they're extrapolative. We know that they're inversely related to market valuation levels, and they're strongly related to stock market participation. But what do we know about long-term expected returns from individuals? Well, surprisingly little. Although asset prices should be a function of expectations over long horizons, empirical work examining beliefs almost universally focuses on respondents' views of equity markets in the near term, typically the following year. And throughout this, I'm gonna basically talk about the near term just for ease of exposition. I'm gonna call it the short term. So why would we need long-term beliefs if we already have short-term beliefs? Well, theoretically, once we've accounted for short-term beliefs, the long-term beliefs should not matter. If differences in short-term and long-term expectations arise from perceived mispricing, then absent frictions, once we've accounted for those short-term beliefs, the long-term beliefs should not be associated with stock market participation, risky share, in other words, the percentage of equity that's held, or it should not be associated with the individual's trading, as one can always adjust their position based on their short-term beliefs. So here are some arguments about why long-term beliefs may still play a role. First of all, reported expectations likely reflect a noisy measure of expectations, as Giglio and co-authors and Binswanger and Salm have pointed out. So if short-term and long-term beliefs are less than perfectly correlated, then both may help explain investor decisions. Second, investors may be more confident about long-term predictions and short-term predictions as they perceive that although stock returns are hard to forecast in the near term, equity markets generally rise in the long term, as Siegel has shown. Another reason why long-term beliefs may still play a role is that they may want to match their holding period. In other words, the investors may want their beliefs to match their holding period. So if most investors have an expected long-term holding horizon, then they may consider long-term expectations as more relevant than short-term expectations in their decisions. And we may find those to be more relevant. Another reason is if transaction costs and trading frictions are substantial, investors' equity holdings may be most dependent on long-term beliefs, and portfolio revisions may be less responsive to short-term views. Finally, asset prices depend on long horizon, in other words, infinite period expectations. So these are reasons why we think that long-term beliefs may still play a role. So just to go through our major findings here, we find that long-term beliefs are much more important than short-term beliefs in explaining stock market participation. So individuals deciding to invest in the stock market, we find there's a much stronger relationship between their long-term beliefs than their short-term beliefs about expected returns. Also, long-term beliefs are much more important than short-term beliefs in explaining the risk share choice. So the first finding that I've talked about is just, are they invested in the stock market or not? The risk share choice is, what percentage of their portfolio is in equity. And again, we find that the long-term expectations about returns are much more important than these nearer term expectations about returns. Giglio and co-authors have found, using short-term beliefs, that the coefficient of the relationship between the beliefs and the risk share choice is much smaller than theoretical values would suggest. When we use long-term beliefs, our coefficient shows that the coefficient is much closer to what the theoretical values would suggest. In some of our other findings, we find that the long-term expectations of returns are more important than the short-term expectations of returns in explaining which investors trade, when they trade, and whether they buy or sell equities when they're trading. We also find in the time series that long-term beliefs are countercyclical, which is inconsistent with what has been found in almost all previous work. And what we also find, which is that short-term beliefs are pro-cyclical. So I think this is a very important finding, this finding that the long-term beliefs are counter-cyclical while short-term beliefs are pro-cyclical. Okay, so our data comes from the RAND American Life Panel. And they issue surveys and they pay the participants. And so the surveys that we're able to use, we have 87 months of these surveys, and participants participate in multiple surveys. So we have a time series of what individuals are believing and also how they're investing. So we have over 3,800 individuals with enough data. As I said, they repeat these surveys. So we have 61 interview waves, in other words, different surveys. 29 of these are what we call the long form survey, more questions were asked, and 32 are short form survey. So in essence, we have approximately 90,000 panel observations because the average person participates in 23 of the waves. So just to give you some background on the respondents' financial information, these are the summary statistics. What we find is that I should have started out with the income is on average around 68,000, and that's out of 89,000 observations. 55% of the respondents hold equity. And 29% of these respondents hold equity directly. 79% have equity in retirement account, and that's out of the 65% that have a retirement account. And then we find that the percent of equity is about 34% in their portfolio. So that's the risky share here is the percent of equity. In terms of their financial sophistication, we find that on average, they have 15 years of education, which is, some college on average. We find that there is some understanding of the stock market. They have financial literacy, and then they're not overly overconfident. We find that about 59% are women, about 65% are married, and about 60% are working, which means we find about 23% are retired, and the average age is 51. So, and the survey questions that we are most interested in our study they tend to be questions of the following format. The first type is, what are the chances that mutual fund shares invested in blue chip stocks like those in the Dow Jones Industrial Average will be worth more in it's either 1 year or 10 years than they are today? And then what are the chances, again, that mutual fund shares invested in blue chip stocks like those in the Dow Jones Industrial Average will have increased by more than 20% in 1 year or 10 years compared to what they are today? And then the opposite of that is they will have decreased by more than 20% in 1 year or 10 years. So in short, we have 6 questions on people's return beliefs. The short-term beliefs, what's the probability it'll increase in the next year? I mean, what's the chance? What's the chance it'll increase by 20%? What's the chance it'll decrease by more than 20%? And then long-term beliefs, we have the same types of questions, except we're asking over the next decade instead of the next year. The long-term beliefs only show up in the long form wave, so there aren't quite as many observations. Okay, so let's talk about the near term or the short term, the 1 year expected returns. And for a lot of this, I'm just highlighting some of the results. So what we find is that the probability that the return is going to be greater than 0 is about 50%, whereas in CRISP, it's been 75% of the time that expected returns have been greater than zero over the next year. And so the percent of these that are less than CRISP is about 83%. And this is consistent with previous work that the short-term beliefs tend to be more bearish than historical values. When we ask about greater than 20%, again, we find that it's more bearish. And the same with less than 20%, or less, or actually, this should be greater than a minus 20%. So the typical respondent underestimates the upside likelihood and overestimates the downside likelihood. So there's this negativity in return expectations that we find for the 1 year expected returns. So, we can think about inferring 1 year and 10-year expected return distributions. If we assume that continuous returns are normally distributed, then we can actually calculate, because we have these two tails of the distribution. So we can calculate an expected return of about 9.5% and a standard deviation of 20%. This requires quantile perceptions follow probability law. So we're going to look at our observations and make sure that they make sense through how they're looking about this distribution of returns, and we're going to Winsorize at 5% and 95% level. And so our number of observations gets reduced from the 89,000 and something to 61,800 about. So if we look at the implied expected return, we find that the median is actually negative here, and this is again much lower than historical. So we can draw a distribution of this. The blue curve here shows the distribution that's implied by the CRISP value-weighted index over time, and then the red distribution is what we find according to the median respondents' belief. So you can see that this distribution is, the mean is too low, it's shifted too much to the left, and then we also find fatter tails than what has been actual return. So comparing, again, this is comparing short-term, near-term beliefs in the red to actual beliefs in the blue. Okay, let's look at the long-term expected returns. For the long-term expected returns, we find that again, we find a median of 51%, whereas the historical CRISP has been 96% that it's greater than zero. So 91% have beliefs less than what the actual returns have been. And then we also find this to be similar in terms of looking at the tails. So the probability of the 10-year return being greater than 20% is again much less than the historical CRISP. And we find, in terms of the downside tail, so the probability that they think the return is going to, in over 10 years, is going to be less than 20%, is now greater than what CRISP would suggest. Okay, so if we draw this distribution, you can see it's much further to the left here. It's a much different distribution, our red distribution that's implied by the median respondents' beliefs as compared to the distribution implied by the CRISP value-weighted index. So more than 99.9% of the area under the long-term beliefs is to the left of the mean of what actually happened. So this is much more negative than actual returns. And so we can imply the 10-year returns from the 1-year returns, and we find that the long-term returns are slightly more optimistic than the short-term returns, but again, nowhere near the actual historical 10-year returns. So why is there such negativity in the return beliefs? You know, where does this negativity come from that we find that both short-term and long-term beliefs that the respondents to these surveys have a much more negative view of return than what past returns would suggest? So I'm going to draw for just a few minutes on a previous paper with Rick and Harry on the negativity bias and perceived return distributions, evidence from a pandemic. Because in this paper, which was published a year ago in the JFE, we provide some explanations for why there is a bias, this bias that I just showed you, which is perfectly shown in this figure, why this exists. So the negativity bias is a well-documented psychological phenomena that humans place greater weight on, learn more from, and respond more strongly to negative elements than positive elements in forming their perceptions of the world. In other words, as Baumeister and co-authors have said, bad is stronger than good. And negativity bias is a permanent facet of an individual's perceptions of the world, and the bias varies across individuals. So our hypothesis in this JFE paper is that negativity bias can explain the heterogeneity in return beliefs, the widespread existence of overly bearish return beliefs, and as a consequence, low stock market participation. Our identification strategy to test the negativity bias hypothesis is, well, first of all, we need to find a measure that satisfies the following conditions. It needs to not be related to a respondent's own economic experiences. The individual's perceptions of this factor need to be influenced by the negativity bias, and perceptions of this factor should capture the cross-sectional variation in the negativity bias. So what we're going to use for this is the true future risk of dying of the swine flu, and then respondents' perceptions of their risk of dying of the swine flu. So the swine flu, to remind you, April 12th, 2009, Mexican officials reported an outbreak of influenza-type illness to the World Health Organization. And the first US case was diagnosed within a week. By April 27th, so this was 15 days later, 5 states in the US had confirmed cases of this, what's called the H1N1 swine flu. And the initial reports based on data from Mexico suggested that there was going to be a very high mortality rate. If you look at the Google trend search histories for swine flu from October 5th, 2009 to December 27th, 2009, you can see that right after this April date, you can see a big increase in searches for it. And then that went down after time. So what we've done, and again, I'm just giving the very simple part of what we did. We took individuals' equity return beliefs, again, from the same American Life panel data. We took it in late February and early March of 2009, which was just prior to the discovery of the swine flu in April 2009. So these are return beliefs before we're going to measure their probabilities of dying from swine flu. So they were asked in the survey what their probability was of dying from the swine flu. And the median perceived swine flu mortality risk was 270 times the actual risk. And we found that 93% of respondents overestimate the risk. So through the survey, we could measure changing perceptions of mortality risk from the H1N1 swine flu. So if you look at this, you can see at the bottom, the red line, that's the actual mortality risk. This line shows the perceived mortality risk, and then this was the mean, and then this shows the standard deviation. So So what we have from these perceptions of the perceived mortality risk is that there was a lot of cross-sectional heterogeneity, and this perceived risk was much higher than the actual risk. And so just to show you, it's kind of hard to see this timeline, but just to show you, this is where we measure the returns, their return probabilities. And then this is all the different surveys where we're able to measure their perceived perception of swine flu risk. And you know, at the first of this, the WHO declared a pandemic, but then there were vaccines, and you know, and then as it turned out, the swine flu was not a serious problem. So we looked at the relationship between the return beliefs and negativity bias, again, where we're measuring negativity bias by individuals' perception of the probability of their dying from swine flu. And we found a very strong relationship. If we look both short-term and long-term, if we look at the relationship, and this is just the coefficient on the probability of dying from swine flu. We have a lot of control variables in here, but the probability of equity returns over the next year being greater than 0 is significantly negatively related to an individual's perception that they will die of swine flu. So this is what we believe is their negativity bias. And we find that it is strongly related to their near-term returns. We can see it's also very strongly related to the probability that returns are going to be less than 20%, and less than a negative 20%. And and then when we look over the long-term returns, we also find a strong relationship between this proxy for negativity bias and having negativity bias in the returns. We also did a number of tests, and we found this affected their stock market participation, and we found that this holds even when considering all alternate theories such as optimism, risk aversion, ambiguity aversion, or anxiety. And so I just wanted to provide this explanation of why we see this negativity bias. But going back to today's paper and looking at the long-term and the short-term return beliefs, and now let's look at stock market participation. So the question is, does the difference between the long-term and the short-term beliefs matter? Previous research shows a strong positive relationship between variation in short-term expected returns and stock market participation. So, you know, then the question is, well, why should the long-term matter? Because we can, if we have longer-term expectations, we can hold stocks now and then sell in a year. So the short-term expectations should be all that matter. But we look at the relationship between stock market participation, you know, whether you hold stock, and your expected return over the next year and your expected return over the next 10 years. And we limit the sample to those individuals where we can observe their short-term expected returns, their long-term expected returns, and their uncertainty about the expected returns. So this is showing, if we just look at the short-term expected returns, then we find a strong relationship. Here the dependent variable is stock market participation. Do you participate in the stock market or not? Do you have stocks, equities in your portfolio? And we find this strong relationship with the short-term return, the 1-year return. When we add, and again, we have lots of controls in here, but when we add the long-term expected return to this regression equation, we find that the 1-year return gets significantly reduced in terms of its importance in the equation. So the long-term expected return is about 5 times as important as the short-term expected return in explaining stock market participation. Further, we find the difference in these coefficients to be statistically significant. When we add the uncertainty in here, it doesn't change the short-term coefficient, but it does actually make the longer-term coefficient to be stronger. Okay, so then on this last column here, I have added the results when we have the respondent characteristics. So those demographic characteristics that I talked about earlier. And you can see that it doesn't really change the 1 year, but it does change the long term. So there is this relationship between these demographic characteristics and the long-term beliefs. It also, when we add the demographic characteristics, that seems to explain the differences in uncertainty. Okay, so those results were the stock market participation. Are you in the stock market or not? These regressions, now we have as our dependent variable, what percent do you have in the stock market? And you can see that the near-term expectations, when it's there by itself, again, there's lots of control variables in here, we find a strong relationship. And then when we put in the long-term beliefs by itself, the long-term expected return, the 10-year, we find an even stronger coefficient. And when we put them in together, we can see that the near-term return basically drops out. It's really the 10-year return. It's the long-term beliefs that are important in the risky share, the percent of stock that is held. And so basically the long-term expected returns are what matter for what fraction of equity is held. And to us, this is very intuitive because as talked about earlier, when you're talking about putting money into stocks, you are talking about a long horizon for the most part, for most individuals. And then we can also see, looking at differences, we can see that these differences are significant. And the differences in the expected returns, but not the differences in the uncertainty about those returns. Okay, so what we also wanted to do was to measure whether the return beliefs affected people's trading decisions. So we can measure trading between the survey intervals because we have information about their trading. And the survey intervals are about 3 months on average. And we also have, because in many of the surveys, we know about their direct equity holdings and we know about their retirement accounts. And there are 4 possible answers with regard to their trading. There was no trading at all in the period. They bought equity, they sold equity, or they traded somewhat ambiguously because, for example, they bought equity in their direct equity holding accounts and sold equity in their retirement accounts, or vice versa. So we have 4 different possibilities for what they did. So we have the no trade, the net buy, the net sale, or being ambiguous. And so we have 18,813 respondent wave observations over this period. And what we find, which is consistent with many studies of individuals trading in the stock market, there was a lot of inertia, and somewhat more inertia for retirement accounts than for direct accounts. So there was not much trading. If you look at the buying and the selling, and again, this is consistent with previous work, is there's even less in retirement accounts selling than in their direct accounts, and we find about twice as much buying as selling in each of these accounts for those who do trade. So these individuals trading, as I said, it's consistent with previous evidence of household inaction and inertia. And it's inconsistent, though, with earlier work on retail traders that engage in excessive trading. And this is probably because of a difference between the identities of the traders who are trading in brokerage accounts versus these are people taking surveys that happen to have direct equity and retirement trading. So we also looked at the trading decisions during the financial crisis. So this is the original one I showed you. This is just their trading after March 2009. And we look at the crisis period, October 2008 to March 2009. And you can see that there was much less inertia during this period because we went from about 75% of people that didn't trade down to 57% of people that didn't trade. So a significant percentage of people traded, and we found that there was given that fewer people traded, we found more buying and more selling, but we also found significantly more buying than selling. Then going back to this original one that I showed, this post-March 2009 trading, let's compare their trading to the changes in their beliefs. And although there's little trading, we found that nearly everyone, well, 90%, over 90%, changed their return expectations in some way. They changed their short-term beliefs, they changed their long-term beliefs, or they changed one or the other. So we find that again, that a huge percentage of them, they changed their beliefs even though they don't trade. And we divided the respondents between the uncertainty about their expected returns, whether it was stable or whether it was volatile, and in terms of near-term expectations and long-term expectations. And we do find significant differences in trading for the long-term beliefs here versus the short-term beliefs. So we can show that there are significant differences in this, although again, we have mainly no. In further analysis, we find that higher long-term expected returns and increases in long-term expected returns tend to be positively associated with both the likelihood an investor buys and the likelihood that they sell. For instance, a 1 standard deviation higher beginning of trading window long-term expected return is associated with 2.2% higher likelihood of buying and 1.4% higher likelihood of selling, both of which are significant at the 1% level. We also show that this is economically significant. So short-term expectations do not affect the likelihood of selling, but do affect the likelihood of buying. We find this difference between where the long-term expectations had significant effects on buying and selling, but the short-term expectations only affected the likelihood of buying. They did not affect the likelihood of selling. Okay, in terms of the time series patterns, there is previous research that show that individuals tend to extrapolate returns. So getting worried about the time, so I'm going to skip some of these. So we're going to look at time series patterns. We're going to look at the lag market returns, and we're going to look at the market valuation measures and how they are related to these the short-term returns and the long-term returns. And this is where you can see here that the short-term returns are pro-cyclical, while the long-term returns are counter-cyclical. And this is whether we're using short-term previous returns or longer-term previous returns. We find this very much of a difference between the short-term beliefs and the long-term beliefs. And when we look at market valuation levels, similarly, we find while the short-term beliefs are negatively related to all of these different measures of market valuations, we find that long-term beliefs are actually positively related to these. So we find these, very much these differences between short-term beliefs and long-term beliefs. We also are going to look at mutual fund flows, the association of individual investor sentiment, and venture capital flows, as well as risk. And we find, again, this difference between the short-term beliefs and their relation to these flows and the long-term beliefs and their relations to these flows. We also find, and I'll just take VIX here, we find that short-term beliefs are negatively related to the VIX, but long-term beliefs are positively related to the VIX. And all of these are lagged. I should have said this before. All of these are lagged. Okay, so in terms of uncertainty, we also find when we do regressions between expected returns and uncertainty, on lagged returns, again, we find this difference between, and I'm just going to focus on the uncertainty since we already talked about the expected returns. We find this difference between the short-term returns and let me say this better, the short-term expected returns and the long-term expected returns in terms of the uncertainty about the short-term expected returns and the long-term expected returns. Okay, given that I'm running out of time, we also find that individuals' demographic characteristics are related to the dispersion in beliefs because they're related to the dispersion in priors, and the priors are relatively more important at long-term horizons. So if we look at the relationship between near and long-term beliefs and respondent characteristics, we find strong relationships, but we also find a significant difference between the relationships. So years of education is much more related to the long-term beliefs, for example. Okay, so in conclusion, because I think I'm past time, in conclusion, we find basically that long-term beliefs work better than short-term beliefs in explaining a number of factors. So long-term beliefs are much more important than short-term beliefs in explaining stock market participation, in explaining the risky share decision, in other words, how much to invest in the stock market. And we find this relationship between long-term beliefs and the risky share decision to be closer to theoretical values than the relation between short-term beliefs and risky share. We also find long-term beliefs are much more important than short-term beliefs in explaining the investor trading decisions. We find that long-term beliefs are counter-cyclical. In contrast, short-term beliefs are pro-cyclical. And we find that the time series variation in long-term beliefs tend to match traditional asset pricing theories better than short-term beliefs. So these time series variations in long-term beliefs, they tend to correspond to some behavioral theories, but they're inconsistent with the behavioral theories that rely on return extrapolation. In contrast, the time series variations in short-term beliefs tend to match behavioral theories that rely on return extrapolation and are inconsistent with traditional asset pricing theories or behavioral theories of extrapolation of fundamentals, prospect theory, ambiguity aversion, and noise trader risk. So in short, the central role of long-term expectations in stock market participation, risk share choices, and trading, as well as the surprisingly strong counter-cyclicality of long-term beliefs, provides some important insights for both theory and empirical work. And I will stop sharing.
Thank you very much, Laura.